Okay, so we will start with this set of questions. By the way, these are real questions from the exam, past exam. So you should practice these questions. These are real questions. I mean, you see, the questions are all, I mean, all questions are the same. If you know your topics and your concepts, but it's, of course, it's good to practice them. It's just to get kind of get just mechanics, right? So you waste less time. That's the point. The point is not if you will be able to answer them, or you will be able to answer them, but you know how much time you have. And so that's where the practice comes in. For people who don't know what they're doing, they can have 6 hours. They cannot answer them because they don't know. But if you know, you still might need to be a little bit faster. So practice is good. So practice is definitely good. Essential, as I said in the syllabus already. So we will start with this set of questions, and then we might or might not finish all of them today. Probably we will, I think it's 14, 15 questions in this set. And then if we have still time left, we can go to a second set of questions, but second set has solutions typed up. So even if we don't cover in the review, you know, you will have full solutions. This one doesn't have solution. This one just has the answer. So, and you don't need to worry about the answers. I will post again answers and solutions today. So you don't need to worry about, am I going to have this answer or not? You will have this answer. So, okay, this is just a little bit too big. Let me see if I can make this a little bit smaller.
Maybe on the right side, right below sign in. No. Yeah, up there. Maybe.
Well, this is find tools. So maybe here in tools. No.
Professor, it might be in the view section.
Sorry?
To the top left, you have edit view. No, to the very top. Yes, it might be under there.
Zoom, yes, excellent, excellent. Thank you, actual size. Usually there's
full screen mode.
Not full screen mode, but like where I can reduce or not. But anyway, let's try like this for now and see. Okay, so we have this business school here, right? And a bunch of information, and then you, as I said often, you know, you jump straight to the question, for example, and you see what the question is about. Well, the question is about spending variance. So you clearly know that this is a variance question. Like, so you know, what chapter would this be? Chapter, I think it's 9, flexible budgets, right? So this is a flexible budget question, right? So you don't waste time with unnecessary information, a lot of information that's kind of maybe not a lot. Usually it's not a lot, but sometimes, you know, information that is irrelevant, because this question might be about whatever, something else. Okay, so this is a flexible. Oh, it's here, you see. Here now it shows a little bit smaller. Very good. So this is a flexible budget question. So what are the things? What does the flexible budget do? We say, what does it do? Flexible budget will help us see where the discrepancy, the differences between what we projected in our planning budget and then what happened in our actual results, right? Those will be usually different. We are not perfect. We are not predicting things perfectly. So now when we get actual results, they're different from planning, but so now we know, now we will use flexible budget to see where these differences are coming from, right? Why I'm going over this and talking about this, because to remind you that the first thing you need when you see a variance question or flexible budget question, okay, so what's the first thing we need? Anybody? What would you start with? What's the first thing you need?
The actual budget?
Actual.
The actual budget? Okay, well, the actual budget is given to you here. It says the school uses the following data in its budgeting. Okay, so this is
Flexible budget?
I would start with a flexible budget and then compare it to the actual budget.
Very good. We have actual results here. So we are given these, but so what do we do with these? We need we always need flexible budget. And of course, flexible budget most of the time is not given to us because that's the whole point, right? So we will start with flexible budget. We will say, I need flexible budget to do anything about this problem. Now, if you need flexible budget, what do you need? How do you create flexible budget? So we need flexible budget.
So since we're looking on the course supplies, I would take the 300 students and multiply it by 10 because this is the variable cost per student. Then I would add 50 times 15 because that's the variable cost per course. And then I would add $1,000 for that because it's fixed.
Okay, so that's very good. This is Guy, yeah?
Yes, that's me.
Okay, very good. I would like your answers to be a little bit more, not just your answer, but in general, to be a little bit more conceptual, right? So not just specifically here, well, you say, I'm going to multiply this by this and then this by this, and I'm going to get my answer. So what I'm looking for is when I say, how do we create flexible budget? Or what do we mean by flexible budget? You will say, okay, well, what I need is, I need these formulas or functions from the planning budget, which is here, right? That's the planning budget. This is the planning budget here. And then I also need actual results in terms of activity. And then I will compare whatever I need to compare. Now, in this question here, you are asked for course supplies. The question might be, what's the variance for net income, right? So you would have to calculate net income, current actual results net income, which here you might or might not be able to find because you don't know what the revenue is, etc. But let's say you can, then you would find, let's say, net income, then you would have to find flexible budget, net income, all the same. So how would you do this? Well, you would say, I am going to use planning budget formulas or functions and actual activity that happened. Now, here you have these distractors, right? It says school budgeted 300 students and 15 courses. Do you care about this? No, because you don't use it for flexible budget, and clearly it's not actual result. Actual result is here, 280 students and 18 courses. Now in this example, it seems like they're using a number of activity points or activities. So for course supplies here, we say what are the functions, right? What do these course supplies depend on? Well, they depend on some fixed cost per month. which is $1,000. That's what Guy said. I'm gonna add just $1,000. So we might say flexible budget for course supplies is $1,000 fixed. And then variable cost per student is $10. So I'm going to multiply this $10 per student. How many students? 300?
No.
No,
No,
it's
280.
280.
280. Very good. 280 because this is the actual result, right? So that's the whole point. 280, so that would be what? $2,800. And and then there's a variable cost per course, each course. So that will be $50 times what? 18 courses. So that will be what? $900. So this is our flexible budget cost that should have happened under these here circumstances, under these assumptions from the planning budget, and under these circumstances, what actually happened in terms of activity. So we have what? 3,800, $4,700.
Shouldn't multiply the 300 by the 10? Because the school budgeted for 300 students, that's the planning one. The actual is what represented in the table below it, no?
Who is this? Is this Guy? Or-
Yeah.
No, Guy, you don't multiply it by 300 because that's the planning budget.
I see.
That's the whole point. If you multiply 10 by 300, you would just get numbers from the planning budget.
I see.
But we are looking for flexible budget. Okay, we are looking for flexible budget, and that's the step one. So step one, flexible budget, create flexible budget. Let me create flexible budget. Boom, we are creating flexible budget now. 10 times 280, 50 times 18, we discussed why. 2,800, 900 plus 1,000 fixed cost, total 4,700. Now, what are we going to compare this to? Well, to actual results, right? So all we are using from planning budget is just these formulas, functions, right? We are not comparing here. This is not activity variance. Activity variance. We did not cover this really, or maybe we just briefly brushed it, but we will not be tested on it. You will not be tested on it, or we will not. This will not be included in the exam. I'm just not sure if, because in the more advanced, in the cost accounting for accounting majors, we cover activity variance. So I'm not sure if I covered it here too, but I don't think I did. Anyway, so it's not a concern. So basically, you are ignoring these budget, these activities from the budget, right? They're not relevant to you. So what is relevant is these actual here figures, and these from the planning budget, these functions. So we have 4,700. What do we compare now this to? Well, to the actual result, 4,800. Now, is this good or bad? Good or bad? Maybe you calculated all of this correctly, but now you don't know if this is good or bad. Is this good or bad?
That's bad because it's less.
Bad.
flexible, it's less.
Well,
So if it's less, why it's bad?
Because you're supposed to spend 4,700, but you spend 4,800.
Yeah, you under budget.
Excellent.
Yes.
Excellent, very good, excellent. I cannot, unfortunately, when I'm recording, it's hard to see who is speaking, and also this is a large group now. So whoever you are, that's a great job. Okay. So we should have spent 4,700 under flexible budget, but we actually spend 4,800. That's the actual result. Well, clearly we spend more than we should have spent. $100 under which assumptions? Under these assumptions here, and under this activity. right? Now, why is this? Well, that's discussed all in a chapter. We will not, of course, go through all of this. But that's why we are trying to figure out now why these 100 happen. It's not just we should have spent, it seems like a little bit less than we did but we actually did somewhere well. Now maybe we spend, because the difference between students is pretty large. I mean, 20 students. So, well, actually that's $200. 20 students is $200 difference, and we spend 100 more than we should have. So there's $100. 5 times 18. That's 900. For how many? For 15. We budgeted 15. So we did more classes, you see. So that's a good thing. That's a good thing. We did more classes. Okay. Everybody good so far?
Yes, Professor.
Yes,
The
Professor.
answer will be 100U, right?
The answer will be
Yes,
100 unfavorable. Very good. Good question. 100 unfavorable. Unfavorable meaning not good.
Not good.
Not good for us. Okay. Okay, let's move on. We will not spend on every question this much time, but just kind of to get our rhythm going on. So
Wait, Professor, I'm sorry. You said that with the flexible budget, that's what we should have spent was 4,700.
correct.
Okay.
That's the flexible budget definition. What we should have spent, right?
Okay.
What should have happened. Okay. Next question. Glove manufacturers manufactures baseball gloves that normally sell for $55 each. The firm currently has 400 defective gloves, which cost company $35 in materials, labor, and overhead. The defective gloves can be sold as is at a reduced price of $18 per glove. Alternatively, the gloves can be completely repaired and sold at $25 per glove. I mean, repaired at cost of $25 per and sold at regular price of $55. Okay. Well, this looks like already right away like something like sunk cost, right? Which again, we covered this, I think, in chapter 1. So that's a long way off. But we said we will need to revisit this in chapter 11. So I hope you revisited it. But the bottom line is, this is kind of this reminds you of what? This reminds you of what? What does this remind you of?
Like selling further, like sell or selling further.
Sell or process further. Very good. Like that topic in chapter 11, joint cost, right?
Yep.
Yes.
Excellent. Sell or process further. Very good. That's beautiful. Okay. So now, I mean, you can even include these 35 if you want, but then kind of if you're just using common sense, if you don't know, if you've never heard of what she just said, and you never took this class, but if you know this, then you would say, well, I mean, this is kind of irrelevant, right? Like, this is the cost that we already spent, and it's cost. I mean, you might say, well, we already spent 35, so we are losing money here, but that's not the point. It's gone. Those 35 are gone already. So you can simply say, now also these 55, are they relevant or not? I mean, is it relevant? There's nothing you can do about this. I mean, 55, this is a normal price, normal selling price, which you cannot get because the gloves are defective, right? Well, now, yes, we come back here to this 55. So this is important too. Okay, so we have it in two places. But Otherwise, this one here would not be relevant. Now, if we didn't have this one, then we would come back to this one, of course, because we need to have this second price. But the bottom line is we have this here price here, 55, which is of course the same. It could have been different. The gloves could have been sold then after repair or for 45 or 49 or something else. So I guess that's what I'm saying. These 55 originally is not kind of relevant. Well, it's not relevant because you cannot sell these gloves right now for $55. That's the bottom line. So these 55 here could have been 49. So what I'm saying is you have to be careful with the problem, right? You have to read problem carefully and say, what's my price now? Well, I can get now $18 for these gloves, $18. That's it. Or I can jump to what?
55.
I can jump to 55, my regular price, but to do this, I need to spend what?
25 to repair.
25.
I need to spend 25 to repair. So it's that simple. Now, what is 55 minus 18 is what? 37?
Oh, no.
37.
37.
37. So this will be gain of 37 for us per unit, right? But we would have to spend 25 to get those 37 per unit. So basically the whole thing would be worth $12 to us, benefit, $12. Okay. And when we multiply $12 by what?
400.
By 400 gloves, we will get $4,800 plus. That's exactly what we have here, right? So you identified the price that you can sell it for now. Boom. You identified the price you can sell it for later. Okay, in this case, that's a regular price of 55. Again, it could have been any price. It could have been 49, 50, 52, whatever. Because we repair them, but we have to tell the customers this is a repair, whatever. So you have to be careful that it's not always this original normal price of 55 here. In this case, it is. So it's 55, right? It's 55. You have two prices now. How do I go from 18 to 55? Well, I have to spend something. I have to spend 25. So 37 plus 25, we have to spend. The total benefit is 12. The question might be, what's your benefit per unit? What's this? What's that? Well, in this case, what would be your net operating income or incremental effect on profit would be? Well, it would be $12 times 400 units, which is 4,800 units.
I'm sorry, Professor, where did the 37 came from?
37 came from the difference between the new price that you can sell it for at 55 if you repair the gloves and the price that you can get for it now, which is 18. So that's where that's the basic. Now, yes.
Sorry, wouldn't it be 37 minus 25 so you can get the 12?
Yes, that's well, the plus sign over there was as 37 positive. That's what it meant.
I'm sorry.
The plus sign next to 37 meant that's positive for you, but 25, I said deduct from 37, you get 12. Yes.
Okay, perfect. Thank you.
12. Now you can go about this, you know nothing again about this joint cost, this, that, you know, process or not process further. I mean, you can use just common sense here, but it would take you longer, you know, to include these 35 also, and then because you would include 35 on both sides, right? You would say, well, I can sell it for 55, multiplied by 400, and then but add 25 and 35, and et cetera, et cetera. So you could get to the same result, right? But that's not necessary. Last year, a company had had sales of 400,000 and capital turnover 2.4 and return. Well, you know right away what this is. The company's net operating income for the year was, well, what do you have? You know, you can write down right away your equations, and this is an open book exam, so you can have all of your equations next to it, so you don't need a lot of time. Net operating income, what do we have here? Capital turnover, sales. Well, you know that net operating income is included in ROI, and average operating assets are here. Okay, so will this help you? Well, you have sales and you have turnover, right? You have turnover. Oh yeah, return on investment is 36%. Okay, so you need net operating income. You have here 36%. Do you have over average operating assets? You don't. But you know that turnover is what?
2.4%.
Turnover is 2.4%, but what is turnover equal to?
Sales over assets.
Sales
over
average
average operating assets.
assets.
Right. So you have sales here over, so you have here 2.4, and you have here sales of 400K. So you find average operating assets here. So you have average operating assets here, and then you find net operating income. But what's the other one? 2. Well, you're told that return on investment is 36%. What is return on investment equal to? Is equal to turnover times what?
Margin.
Times margin. Right? So you can do this too.
So can you divide 0.36 by 2.4 and then multiply it by 400,000?
Right? So we have here 36%, or I should say 0.36. So be careful when you're doing calculation, I mean.
Over 2.4.
So we have here 2.4. Well, actually, in this case, it will be 36. 36 times margin, right? And then, of course, we divide 36 by 2.4, and we get our margin. Margin is equal to what?
Equal to, and we
15.
and we divided by
Net
sales.
operating income divided by
Divided by sales. So you can go in a number of different ways, as you can see, and find the answer. So the answer should be, I guess, $60,000. $60,000. Is this correct?
Yes.
Yes, Professor.
Okay, very good. The answer should be $60,000. So just be careful when you are, again, depending on how you use your which equation, what you're typing in your calculator for percentage. Okay, question 4. Next 4 questions. So we have here next 4 questions which will relate to budgets, right? All of these are always included on the exam, so you have to know how to do what. For example, you have to know how to collect your cash. You must know this. We said this many times. You have to know how to pay for your purchases, cash disbursements. You know, accounts receivable, it's the same thing, like collecting cash or accounts payable as paying for purchases is just kind of just a portion of it, right? Either what other people owe to you or what you owe to others at the end of the period. So these are the 4 questions that we have here. But let's look at this. Let's look at the question first. Let's look at the question first. So let me reduce this further.
Can I ask a quick question about this type of questions?
Yes.
Sometimes in the questions I see, sometimes it can be June or it can be June 30th. Is there any difference in calculations when it's coming to them? When I'm approaching the question.
What do you mean, June or June 30th? For
Sometimes
what?
the question rephrases that it's for the month of June, and sometimes it's for June 30th, the end of June.
But what question? Like if it's cash collections, then it's for the whole month, for example. If it's cash disbursements, it's for the whole month. So it's not going to be June 30th. It's going to be June. But if it says accounts receivable for June, then you don't need to be told, like here. What are the accounts receivable? You see, it says at the end of December. So you know it's end of December, or it's June 30th, like you say. But you don't even need to be told this at the end. Well, you're told because, yeah, somebody might make a case. Well, are you asking me what are the accounts receivable in the middle of the month, or so it says at the end of December. So that would be for in your case, June 30th or December 31st here or something. But you know that, the question accounts receivable refers to always the end of well, not always. That's why it's here at the end of December, because it refers to the end of the month. Same thing, accounts payable. What would be at the end of December, right? Or at the end of June. Is that what you're asking, or?
Yeah. Yes. Kind of.
Okay. So that's well, it's not kind of. It is or it's not.
There's another specific questions from the promise you gave us that I have a question about. Maybe we'll reach it later on during this session. So I'll show it to you.
Okay. Here.
Yes.
December.
Oh, no, I don't think it's this one. It's from the practice questions you posted. It's question number 5. I don't think it's the same file.
Yeah, June 30th.
Yes,
Okay.
that's.
So, well, it says uncollected receivables, right? So that's account receivable. And it says here, account receivable as of June 30th. It could have said, like in the other example, account receivable at the end of June. Account receivable is at the end of the month. Now, yeah, I will agree that the question should probably say at least at the end. So, but it's not going to say just June, right?
Okay. So usually questions about cash collections would be during the month itself, and accounts receivable would be in the end of the month, correct?
Because that's the point in time, correct? That's the point in time when you want to know what your accounts receivable are at the end of the month. I mean, again, in real life, you might want to know what your accounts receivable are in the middle of the month. So we are saying here at the end of the month to be precise. But in terms of cash collections, you want to know throughout the whole month and for the whole month how much cash you collected for the whole month. Don't make this too complicated, guy. It's very simple.
Thank you.
So next 4 questions. This is more important than is it June 30th or no. All information is there. We have a lot of information here, right? So people who are here today and who will review this recording, will know not to waste too much time with all of this information. But people who don't might waste a lot of time on questions like this. So, what is this balance sheet doing here? Is it important or not? Well, it might be important. So we look at instructions, and we say collections are expected to be 80% in the month of sale, 19% in the month following the sale, and 1% uncollectible, right? We did this in the class and said in our lectures and said, well, 1% is uncollectible, so that's gone. We don't need to worry about this. But how many months are we dealing with here? We are dealing with 1 month of sale, and we are dealing with the following month. So that's 2 months, right? What is the question about? Which month? Well, the question we saw below was about December. And the balance sheet is for what? October, right? So is this information here below relevant really? Well, some of it is relevant to December, but do we really need to spend a lot of time analyzing all of these numbers and wondering which number, what should I do with all of this information here or not? Well, in these questions and similar like this, so again, we look at what period are we talking about? Now, if the question is for November, yeah, then we might have to look at October balance sheet, right? But if the question is for December, we might use some of the information from this balance sheet, but we don't have to because we have all information here. We have 1 month here and 2 months here. So that's the period. So we have 2 months, this month and this month. We have all information that we need there. Also, in terms of merchandising, paying for merchandise. Let's see, do we have an ending merchandise inventory at the end of each month? Payments for merchandise is made in the month following the purchase. So it's 1 month thing, 1 month thing. And it's also asked about December, right? What are you paying? So let me ask you, the question is how much are you gonna pay? So that's important thing not to waste time again, because you might realize, well, I got the wrong number, and then you go back and then you redo it. But you will just waste like a few minutes to do the calculation, and then you wasted your time, and then you have to go back. So now payments for merchandise is made in the month following the purchase. So if the question is, what are your payments in December?
It will be in January.
So are you paying? So you say in January, okay, so that's a good guess, January.
It would be November, right?
Very good, November. Why not January? Because think about it. If it says payments for merchandise is made in the month following the purchase. So what you are thinking, who said January, you are thinking the question is about December payments. So I'm paying something. Paying something. What you're saying, well, you connect following month with December. You say, well, I'm going to pay January in December. But that's not the case. It says here, payments for merchandise is made in the month following the purchase. So when did you do the purchase?
November.
You did purchase in November, correct? You did purchase in November. You purchased it here, and then you paid it in December. So, so that's a little bit confusing, right? So you have to pay attention to the wording. So you
Okay,
made
I get it now.
Right. On credit, let's say. It's a credit. So you pay in December. So that's one thing, not to waste time. So now let's look at the rest. So what are our what was the question? What are our collections, for example, in December? What are the collections in December? Well, collection expect to be 80% in the month of sale. So if we sell 230, in December times 80%, so that will give us something. And then 19% of December will be collected where? In January.
January.
19%.
December is gonna be 184, Professor.
Huh?
184.
Okay, 184. Very good. Thank you. Whoever is doing, just keep doing it. But then we have November, and again, I think I did this fairly well and explained in the original lecture. So you can go back to, you organize this whichever way works for you, kind of lining it up and things. So I would probably start with the month of sales, like here, 230 times 80, 184. And then I would say, well, 19%, like here, I would collect in January. But then there must be something else. Well, then I will say 260 in November, or maybe I would put it here, 260 times 19%. 19% will be collected here too. Right?
Professor,
So
that will be 49,400.
Okay, 49,400. Very good. So this total would give us
233 and 400.
Okay. Excellent, excellent. So that should be our answer. So let's look at below. 233,400. Very good. Okay. So as you can see, we did not need this balance sheet for this. Cash, accounts receivable, nothing. We didn't need any of this because we were just dealing with December and November. Let's do the next question. The next question is how we pay for things in December. This one is more interesting, right? This one is more interesting. So how do we pay for things in December, I believe? Let's see. December cash disbursements for merchandise purchases. So we just discussed that we have to pay attention not to waste a lot of time and do the calculation for December actually, but do the calculation for November, right? For November. Now, we can use maybe something. So for example, here, what can we use from balance sheet? If we needed it, like for example, in this case, probably merchandise inventory might be relevant if we are dealing with payments for November, but we are not dealing with payments for November. We're dealing with payments for December. So what do we need? Well, how do we calculate how much we have to pay? The cost of goods sold are 65% of sales. 65% of sales. And again, we remember that we are dealing with which month? With November month. So, and we also need to include some inventory that we need at the end of the month, just in case for the following month, but we also brought in some inventory. So this makes this question a little bit more interesting, right? So in this case, we have 260 here. We have 260 times 65% in our cost of goods sold, which would be something, right?
That will be 169,000.
169. Excellent. Great. We are doing great here. Not very fast, but we are doing great. Now we need some ending inventory, right, for the following month, and the ending inventory is what? Based on the following month sales. So that's 230 230. So we need plus some ending inventory. 230 times what? Well, we're talking about cost of goods sold, 65%.
60%.
65% times also 60%, or either way, you can say 60% and 65%. I prefer to say first to remind that it's cost of goods sold, not the full 230, right? So what would this be?
89,700.
89,700. Okay, so this is something that we would add, and then minus the beginning inventory, right? What was the beginning inventory for November? Well, it was 260 because that were the sales times 65%.
60.
Times 60%. How much is this?
One oh one.
156.
No.
101,400.
101 and 400.
101,400, right? And where do you find this number? Well, you find it here, because that's the merchandise inventory for October, right? For October. At the end of October, you had to have how much inventory? Well, you had to have enough inventory to cover beginning inventory for November, right? That's the requirement. And that's exactly this number here. But you can see that if this balance sheet was not even included here, let's say it was not existent, you could still find this number here. So many students also, as I said in a lecture, they get stuck, how do I find my what was my beginning inventory for November? Now, if you're given this balance sheet, then you know, well, you have to know what to look for, and then you find merchandise inventory 101.4. But you don't need it actually, right? So I would suggest, if you see, when you look at, just to save time again, not to ignore things, but to save time, if you see, for example, that your question is about December or here for January, and you're just dealing with 2 months previously, October is pretty much irrelevant. Now, in this case here, it's relevant. You can find it here, but you didn't need it. You could find this number yourself, right? So what's the answer here? 169 plus 89.7 minus 101.4 is what?
$157,300.
157,300.
That's what I got.
Okay. Okay, let's see if this is correct. 157,300 it is. So this is our so this was a relatively challenging kind of a procedure, right? You have to know a lot of stuff here to answer this, and a lot of times students get these questions wrong, even though they are not very difficult if you think about it. But there's nothing; it's kind of just calculations. But get the wording, and then again, if you waste a lot of time looking at things that are not even important to you. Okay, next question is accounts receivable at the end of December would be accounts receivable. What does this mean? Well, whatever we did not collect in December, and that should be kind of a 10 seconds question, right? Whatever we did not collect. What are our collections? Our collections are 80% in sales, 19% following the month sale, and 1% uncollectible. So it's basically the answer is 19% of 230. That's it. That's the amount that we did not collect in December. Now, for what's my accounts payable in December is a little bit longer. Again, it's the same procedure as for November, except what? Exact same procedure as for November, except what?
We calculate
We calculate October?
We calculate December accounts payable.
Very good, very good. We just calculate December, right? Why? Why do we calculate December? Well, because we will pay December when?
January.
In January, in the month following the purchase. So just be careful, that's all. So be careful with, yeah, like I think these are the things that give students most problems, to kind of say, well, what the hell, what do I do here? Like, you know, which month am I paying forward? Well, just be careful and take 3 seconds to get it down right and say, okay, let me get this down right. I'm making a purchase in some month. It doesn't matter which month. I'm making a purchase in 1 month, and then I'm paying for this purchase in the next month. Well, if the month that I'm paying it in this is December, then I made a purchase in November. So that's what you are then calculating. But if the question is accounts payable, well, then that at the end of the month, that's what I still have to pay in the next month. So then I'm looking at December in this case, right? Because that's the question is. So we don't need to go through the whole question. It's just the same problem as this problem, except calculation is for December, right? Any questions about this before we move on?
Can you just explain 6 again? You multiply 19% by what?
Question 6. Well, what's the account receivable? What's the meaning of account receivable?
You sell
Money
something
that you
and
still
you
have to
collect later.
No, the person who asked the question, what's the meaning of account receivable? The meaning is that we still need to collect this from somebody. We collected already 80% for December in December. So the only amount that is left to collect for December, not in December, but for December is 19%, right? So that would be accounts receivable. Now, sometimes you have question where you're collecting over 3-month period. Let's say 80% in the month of sale, 10% in the following month, and then another 10% in the second month. Well, then in December, you would have those 10% plus the other 10%, for example, right? Or whatever it is. We have examples like this on Blackboard and in narrated lectures. The corporation flexible budget formula. So this is flexible budget question. Indirect materials variable cost is 19 cents per unit of.
How
Yes?
did you number 7 again? I think I missed that.
I'm sorry?
Can you explain question 7 again?
Question 7 is the same as question 5, except you are making calculations for December. Question 7 is the same as question 5, except you're calculating amount for December, not for November. Why? Well, you will need to go back to this and to the, I guess, the recording. The corporation flexible budget formula in the variable cost is 19 cents per unit of output. If the company's performance report is 500 unfavorable spending variance for indirect materials, and if 8,000 units of output produced per month, then the actual cost incurred for indirect materials must have been what? Must have been what? This is probably a little bit more kind of challenging, but so the actual cost incurred for indirect materials for the month must have been what? If the variance was unfavorable, $500 for indirect materials, 8,000 units of output were produced last month. then the actual cost incurred for indirect materials must have been what?
So it's 0.9 times the 8,000 units, and then you add the 500.
0.9 times what?
8,000,
8,000. That will be what?
7,200.
7,200. Now, who is this?
Angelica,
Angelica, beautiful Angelica. 7,200. Now, why are you adding 500 to 7,200?
since it was unfavorable, you spent 500 more than you should have.
Ah, beautiful Angelica. All right, maybe I should write this down, Angelica, and then look at your, maybe give you imaginary 1 point later.
Thank you.
All right, so what Angelica is saying is, this is our formula, right? This is our budget formula from our planning budget.
Hello.
Is it me or
Is it me or?
No, I don't think. I think it's the professor.
What's
I
up,
think
man?
Oh, okay.
I think maybe it's Mike. Like.
Oh.
Hey guys, I didn't get quite the question number 7. Do you know how to do it? I don't know. What did he say that he didn't add or take in question 7?
So you find first you take the value for December, the 230,000, and you multiply by 65%. That's the amount that you're going to need to pay for that month. Then you find the amount that you're going to have to pay for next month's inventory that you need. So you do the 210 times 65 times 60, and you subtract the 230 times 65 times 60 to find the amount for November. It's the same as number 5.
Okay, got you.
Just
Got
different
you.
months.
Okay, got you. I was like, just the first is the beginning inventory. Here I have to like subtract the ending inventory, right?
Yes.
I think you subtract the beginning inventory.
7.
Okay, I'm glad you're not wasting time while I got disconnected. So Angelica was right here. 90 cents times 8,000. This is our flexible budget, $7,200. And then she said, well, this is how much we should have spent, $7,200. But because this variance is unfavorable, we have to add this to the 7,200, so that's 500. So that's 7,700. Okay. Again, this is probably a little bit challenging. So I don't think I'm going to include anything like this on the exam. For the person who was asking about budget, solutions will be included in the next, in the other set of questions, but you should be comfortable with this already. Given the following data, what is the residual income? Angelica, go ahead. You're on a roll. Continue. What is the residual income?
The residual income, I think I forgot the exact equation.
Don't worry about the equation. Forget about the equation. Think in terms of kind of common sense. What would this remind you if you didn't have any notes, anything with you on the exam?
So
What is
I did 100,000 times 10%, which gave me 10,000. And then
I think it's for 40,000 minus
I'm asking what is the residual income, and then we will quickly get to the answer. Don't worry about numbers now. What is the residual income?
It's not net operating income minus the average operating assets for minimum required rate of return.
Excellent. Who is this? Who is this?
Joanna.
Juana.
Joanna.
Oh, Joanna, that's great. But tell me even in more. Okay, so net operating income minus what? Minus the minimum that we were required to make on our assets, right?
Mm-hmm.
That's very good. Excellent. So you see, this is now much easier then. You say, well, net operating income current minus our minimum on what? Well, of course, on average operating assets. So what is our minimum that we should have made? Well, our minimum is here, 18%. And our average operating assets are what, 40,000. So we are talking about what? Less than $8,000. 1% is what?
7,200.
7,200. So we were supposed to make 7,200. This is our minimum. This is our minimum, right? 7,200. Anything above this would be our residual income. And what is above this?
10,000.
What is above this?
You have to find the net operating income.
We have to find net operating income. Okay, so what is the net operating income? Our return on investment is 25%. Our average operating assets are 40,000. So our net operating income is 10,000, 10K.
Then the residual will be a difference, which is 2,800.
2,800. Very good. Excellent. 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 So so that should be also like 30 seconds question. 30 seconds. The following data for the month of July for company. Okay, so this is an interesting question. What is the flexible budget operating income? What is the flexible budget operating income? Okay, so let's say here, flexible budget. Flexible budget. So what do we do now? We have planning budget income and we have actual results. How do we create flexible budget? Review again.
We use the price from the planning budget and then the activity level of the actual budget.
Excellent, wonderful, beautiful, beautiful. Ladies, you are killing it today on this review. Gentlemen are also not bad, especially those who are helping me with calculations. Let's see here. So we say $85 per unit times actual results, which would be what?
102,000.
110K.
No,
Okay.
102.
It would be 1,020,000.
1,020,000.
Yes.
Okay, Guy, do not contribute anymore. Just kidding, just kidding. 1,020,000. 1,020,000. Now, what are the variable costs? Well, 60 times same 12,000. So that would be what? 720, right?
720.
Yes.
720. Very good. Now, which fixed cost are we going to choose? Which fixed cost are we going to choose? 135 or 133?
135.
Who is this?
Change that.
All right, why 135? Why 135? Why not 133?
Because it's fixed.
Because we're calculating
actual-
flexible and we're using the actual 133 for comparison later.
Because it's fixed, Professor. It should be the same.
Okay, well, there are a couple of things. I like what somebody said, because we are doing flexible and we will compare it to the actual, which is kind of very good thinking. But and then now you're saying because it's fixed, it's fixed. Well, I get it, it's fixed, but it's different. So it seems like it's not completely fixed. Well, it's fixed, but not the change is not related to the results. But even more basic. Why are we using 135? Even more basic answer.
From the pending budget.
Exactly, from the planning budget. We are using these functions from the planning budget, period. It doesn't matter that it's that this one is fixed and these are variable. We are using them from the planning budget. That's a very all of you gave a very good answers. Okay, so we will use here 135K, and this should give us $165,000 in flexible budget net operating income. Now the question might be, what's the variance between flexible budget net operating income and actual results net operating income? Well, then you would calculate here what's going on with this. You would find here net operating income, and then you would compare these two, right? But that would be just another kind of step, nothing else. Everybody good? Any questions about this?
Can you explain how you got to 165,000?
How I got what?
165,000.
Well, I just explained it, so you will go back to the recording. So we created a flexible budget.
No, I got the big numbers. Do you just add all of them, or?
Well, you deduct you deduct cost from revenue, right? We had the revenue number, and then we had cost. We had variable cost, 60 times 12,000, and then we had fixed cost, 135. So finally, when we deducted those costs from our revenue, which I think was 1,020,000, we got 165,000 in.
You subtract.
Thank you.
You subtract cost from the revenue, right? That's the net operating income. The company makes, okay, long question. A lot of here you see a lot of stuff. So again, let's say start from question. So you don't, it depends. It might be completely different things. So you are, what the annual impact of the company's profit if the company buys the part from the supplier instead of making them. Okay, so now you have scenario where you are making the thing, and then you have the second scenario where you are not making the thing, but you are buying it from somebody else. Okay, so it looks like a long problem, a lot of information, but let's see how quickly we can do this. So we are talking about 1,000 units, and this is the unit cost right now. So this is our scenario right now. This is how much it costs us to make it, $55. It includes everything, fixed cost, variable cost, blah, blah. And outside supply has offered to sell the company $58 per unit. So you say they want to sell it to us for $58. For $58. If the company accepts the offer, the facility is now being used to make part, could be used to make 2,000 units. Okay, so be careful with this. Let's leave this for a moment on the side, right? So you say, okay, I'm gonna leave this on the side for a second. If the part was purchased from the outside, $10 of the fixed manufacturer cost being applied to the part would be eliminated. Okay, so what we are saying is we have to pay $58 to them, to make it for us. And then let's look at fixed costs here. It says 10% would be eliminated, which means what?
You still have $10.
Wonderful.
Yeah.
Beautiful. Who is this?
Guy.
Guy. Okay. All right, Guy. Okay. Okay. You're allowed to come back in business. Okay. So you still have to continue with 10. So you need to add these 10 to this. So now you say, okay, well, does this look like a good deal to me? Right now, I'm making it for 55, but if I cancel all of this, I'm going to have to spend 68. Well, that doesn't make sense. Well, first of all, it's not this number 58 is not great, because you would say immediately, well, why would I pay 58 if I'm making it for 55? But even if this was 48, right, which would then look better, which we have in our lectures, examples like this, and then we add 10, it would still be 58. So it would still be higher than this, so it would not be good. But anyway, here we have 68, right? So because the question might be, what would be the profit like here, increase, decrease, or whatever. So right now the decrease, it would be decrease clearly of like $13 per unit for 1,000 units. So that would be $13,000 decrease if we decide to shut this down and buy it from somebody. However, now we can come back to see, you don't need to get overwhelmed with all information in one shot. You do kind of the basic stuff first, okay? So you got here. So you already have some idea what's going on. Now, see, this might be the answer, but that's a trick answer. So if you just finish with this and you say $13,000 decrease, that's a good answer, but it's partial answer, so it's not correct. It's not correct because you did not include everything. But you know you have something else to include. So you also know that this is not the correct answer. It looks good because you did a part of your calculation correctly, but it's not full. So this is not a good answer. And then there's something else. You know that it's probably not increase. It's probably not increase here. Well, let's see. Well, actually, I shouldn't have said because I didn't look at the number of units that they're dealing with. So I shouldn't say it shouldn't be an increase. Okay, so that's my bad. That's my bad. Now, let's go to these 2,000 units, right? Because it's a large number of units. And here it's 1,000 units only producing it. So now we have 2,000 units here. Usually the discrepancy is not like this. It would be like 200 units or 300 units or something. This is a big difference, 2,000 units. Like it would double our production, current production of 1,000 anyway. So that's why I assumed right away it's not going to be increase. So we have 2,000 units at what? At what?
$10 per unit for contribution margin.
Very good. So that's $10 per unit. That's a big contribution margin now. We have 2,000 units at $10 per unit, right? So that's 2,000 units times 10.
That's $20,000 of contribution margin that you could take off of the buying.
Very good. So that's $20,000, or you can say what? 20,000 if you're working with units, like you're working here, $68. Now you're at $68. You're comparing it to 55. You can say $20,000 here divided by 1,000 units here is $20. So we can deduct these 20 from these 68. So we would end up with what?
$48
per unit. Now these $48 per unit you compare to $55 per unit. You end up with what?
A $7,000 increase.
$7 per unit cheaper to buy it, right? And times these 1,000 units, $7,000 increase.
Can you
Okay.
explain the
I
sentence?
work.
Sorry.
Which one?
The last sentence where it says, if the part was purchased from the outside supplier, $10 of the fixed manufacturing overhead costs being applied to the part would be eliminated. So can
Right.
you explain the sentence, like what it means in terms of like how you added the 10 to the 58? Why did you add it instead of subtract if it's being eliminated?
Well, because your total fixed cost is 20, so 10 would continue, as Guy said. That's why you would have to add, right? Now, if you're asking me why do we have to add, not just why do we have to add these 10, but why do we have to add this period? That you need to go back to the chapter, right? You need to add because they would continue. These 10 would continue. Are you with me? The person who asked.
Also, you're saying that the 10, okay, so it was 20 and now it's going to be 10 instead of 20. So you add the 10 to the one that you're buying. Okay, thank you.
Right. You have to add 10 because 10 would continue. So you cannot get rid of them. Again, you would need to, this is kind of, if you, this will not work if you didn't go through so you will probably need to go to chapter 11. You still have a lot of time the whole week. You need to go to chapter 11 and look at this topic, right? Why do you continue these 10? It just happens to be 10 and 10, right? You are eliminating 10, but 10 will stay because these are 20. Let's say that these 10 here are 7. Okay, the person who asked now, how much, then what would you do? If these 10, if this 7 would be eliminated instead of 10, if 7 would be eliminated, what would you do?
You would add the 7 to the 58.
Yeah, no, that's what I'm saying. The 10 was not a great number because they're both 10. You would add 13 to 58.
Right, okay.
You would add 13 because 13 is the difference between 20 and 7. Are you with me?
Yeah, I see what you're saying.
Yeah. And why would you add 13 is because 13 would continue. 7 you could eliminate. So please go to chapter 11 and review this. Now, this last thing is because the question is set up in units, as you can see. So we worked with units with everything. So you kind of have to convert these 2,000 units at $10 margin. You have to convert it into, well, I worked with units, and as I say, I like working with units, so that was fine for me, but you might want to convert things into totals because some, for some of you might like it better. But I say here, okay, 2,000 units times $10, that's $20,000 as your the other student said, $20,000. Now, so what do you do with these $20,000? Well, you can convert all of this into full amounts, right? You can say here 55K versus 68K. Why? 68 times 1,000, 55 times 1,000. So you're working with totals, right? 55K, 68K. And now you deduct these 20K. Why? Because that's your benefit. That's your contribution margin. So you end up with 48K, right? So this is maybe better for many of you, right? And you say, okay, right now it costs me 55, but if I do all of this thing, it would cost me 48. So I would choose this one, and it would be $7,000 benefit to me, $7,000 increase. I worked with unit throughout, so I say, okay, 20,000, then I will divide into these thousands. So this gives me $20 per unit. 68 minus 20 is 48, which is the same thing. Just it's kind of neat because everything is just multiplying by 1,000. It's simple. But if the numbers were a little bit different, 1,500 or this, then the numbers would be a little bit more, not kind of a little bit messier, right? But the bottom line is you get the same answer. You get the same answer. Any questions about this? You need to know this. And again, I think we did it now here.
Professor,
Yes.
so are we considering this fixed manufacturing overhead as traceable? That's where we accounting it? Because we normally don't add fixed costs to our variable expense. No?
Well, don't, yeah, unless you see things like, well, traceable, first of all, traceable, if it's traceable, right away, you're leading it to this. If you're eliminating, you're eliminating, right? You're kind of, and yes, a part of chapter 11 has one topic that is kind of similar to chapter 7, when we're focusing strictly on segments, on traceable fixed cost. But okay, you can say that out of these 20 here, here, you might say 10 are traceable, okay? But we don't care if we call it traceable or not. The bottom line is that it says that 10 can be eliminated. So you can call it traceable or not traceable or whatever. You don't care about this. What you care about, that you are told you can eliminate 10. So 10 of these 20 can be eliminated, but 10 cannot. They will continue.
If the question didn't say that we could eliminate 10, would we then still use the 20 in the problem, the 20 original fixed overhead, and calculating the new cost?
Absolutely. That's a great question. Yes, absolutely. If the question doesn't say anything, or if the question, usually the question would say fixed cost or whatever cost, other some, will continue, cannot be eliminated, or blah, blah, blah. The bottom line is it would stay. Well, you would just use 20. Then you would say here, what, 58 plus 20, plus 20. So then you would have 78. Now what? It will be then later with this contribution margin minus 20 again. Again, the numbers here just kind of happen to match things, but they're not always like this, of course. So you would end up with 58 again, which in this case would not be still, well, in this case, you would not have increase, you would have decrease, right? So for example, in this case, it would be $3,000. And this is actually, you see, that's a very good question. You see, you have, because there's an answer here, 3,000 decrease, which would exactly represent this. So if you made that mistake, for example, you did not eliminate these 10 here, you continued with 20, you would, but you did correctly this contribution margin here, you would get to 58 compared to 55, you would get 3,000 decrease, but that's not a correct answer. Very good. Okay, so we are getting here good questions.
Professor?
Yes.
I understand all the mathematical parts, but I just don't understand what's going on in the storyline. Like, if we accept the other product, like if we buy it from another manufacturer, are we still producing 2,000 units, or like where exactly are these 2,000 units coming from? Are we producing it and buying it at the same time?
Yes, if we buy it, then, okay, let's read the sentence.
No, I understand the mathematical part. It's just the story. Like, I don't understand the question as it is.
Yeah. So let's read the question. Right now, we are making 1,000 units, right? And that's all we are making. We are making 1,000 units.
Yeah.
Now, somebody comes and says, I can make all of these units for you, these 1,000 units. I can make them all for you. You don't need to make them. Okay. And if you accept this, then things will happen. As we said, then you would eliminate all of this because you don't need materials, you don't need labor, you don't need this. You would eliminate $10 from here because you can, because that's what you're told here. But you would have to continue these 10. Now, what's with these 2,000? Well, because you're not making any more these 1,000 units. And think about it, it makes sense that you're continuing with $10 here. So that's your capacity, right? So you have certain capacity here, some machines or whatever. that cost will continue. So instead of making these 1,000, now you will make these 2,000. And yes, of course, you have to buy these. These are different units. This is a different product, right? Maybe it should have said here the facilities. You see, the facilities now being used to make the part could be used to make 2,000 units of a new product, of a different product, right?
Okay.
Right. So maybe one word was missing here. 2,000 units of a different product. So now we would buy, of course, these 1,000 units here because we need them, but we would also make another product that we could, make $10 per unit on it in contribution margin. So yes,
Right.
at the same time you would buy, but you would make these 2,000 only if you can free up your capacity, right? If you can free up your manufacturing, otherwise you cannot do it. You have to make these 1,000. Is this
Okay.
clear now?
Yes, very clear. Thank you.
Okay, great. Yeah, chapter 11 is challenging, as I said, man. So you have a whole week still. You can go and still review chapter 11. Okay, we did this question in a number of different ways. Okay, it looks again complicated, a lot of question marks here, but we just go in circle, round and round. Like we know our equations. These are questions that are more challenging in a live class when you don't have any notes, you don't have cheat sheets or anything, so you have to know your stuff, you have to know your equations. In your case, you have your things with you, so question like this would not be too difficult, right? So what's the net operating income for year one? What's the net operating income for year one here? Well, we have to start from somewhere. So it says the division margin in year two, the division margin, so this margin is 150% of margin for year one. So this one here, right? Okay, well, what do we have? What do we have to work with here? What do we have to work with here?
We could use the return on investment and the turnover.
Very good. We have a return on investment here and turnover. So our margin is what? If our margin and turnover times gives us this, our margin is what?
0.12.
12%.
12%, right? 12%, not 0.12. Be careful. 12%. 12%, because 12 times 2 will give us 24, right? So how much is our margin now here?
8%.
8%, very good. Why 8%? Well, because margin 2 is 150% of margin 1, right? 150% of margin 1. So that would be 8%. And now you can, of course, figure out net operating income. So that's, again, that's an easy question as long as you know your equations. As long as you know your equations. The corporation manufactures 3 products. The following products, so we have letter openers, LV statues, candle holders, etc. The corporation experiencing a lack of skilled workers and has only 1,800 labor hours available. If the corporation can sell a maximum 500 units of each product. So we said this is a fairly simple procedure here that we should know. Very simple procedure. The only thing sometimes here that is that sometimes you have to convert maybe whatever the constrained resources into units or something like that. So like in other examples, you're given in a different format, right? And then in total or something, you have to translate into units per unit or something like that. So you can calculate per unit contribution margin. But in this case, what's the first step right away? What's the first step?
You find the
Anybody?
margin per labor hour.
Margin.
No, first you find, yes, actually that's the end of it. Find contribution margin per labor hour, very good. But first you would find contribution margin, right? Kind of very step by step. So contribution margin here would be 10 CM. CM would be 10. And then contribution margin here would be also 10. And contribution margin here would be what?
22.
22, right? And now you would go to the second step, which is find what is contribution margin per unit of constrained resource. And you would say unit constrained, each one is using, this one is using 1, so 10 divided by 1 is still 10. This one is using 2 per unit, so 10 divided by 2 is 5. And this one is using 2, so that would be 22 divided by 11. So which one would you produce first? Well, this one, of course, you would produce first because it has the highest contribution margin per unit of constrained resource. This one would be second, and this one would be third. How many of each can you produce? Well, this one you would produce to the maximum, which is 500 units. So you would produce maximum of these 500. Each one takes 2 hours. So times 2, that's total of 1,000 hours already. And remember, you have 800 total. Now this one is second. You would produce 500. Each one, why would you produce 500? Because that's the demand. That's the demand. If the demand is unlimited, then you would produce these and that's it. You would produce these and that's it. But you can produce now 500 of these times 1, that's 500 hours. 500 of these times 1, that's another 500. So now you have 1,500 units. I mean 1,500 minutes. And you're left with what? 1,500.
300. 1,500.
Total, you're left with 300, right, minutes. And with 300 minutes, what can you produce? Well, each Elvis statue takes 2 hours, so you can produce 150 Elvis statues, right? And we have some good examples of this in the lectures and also in the narrated exercises. So take a look at those too. That's all you need to know about. I mean, again, depending on how just the problem is set up, but this is really the kind of the basic. Okay, another very long problem here. Very long problem. So we jump straight to the question. The minimum acceptable price per unit. Okay, so that sometimes people don't like this. Well, remember, the minimum acceptable price would be where what? Where what?
Break even.
Very good, guy. Very good. Very good. Excellent. You will redeem yourself by the end of this session. Where it's break even, meaning it's equal either way. Either way, it's even. That would be your minimum acceptable price, right? Minimum acceptable price. Usually you would like to, a company produces a single product. So this is a question of, we are making things and then it says below an order has been received from an overseas customer. So that's a kind of a special order. So we would like to get higher price, but that's not the question for us here. The question for us here is what will be the minimum acceptable price, and that will be the price where we make no profit, right? The price is equal to our cost. Price is equal to our cost. Now we have some interesting interesting, then twist here also, we would have to cut into our production, right? So our price will be a little bit higher than what would be without this cutting into our production. So again, break down the question like I did in the question earlier. Break it down into first the basic piece, kind of the essential, right? The basics without this extra thing like cutting into your special order or opportunity cost or whatever. So get down the basic number, and then think about what do I do now with this extra information. So what would be the basic number, the very basic number? Well, first of all, do we care about this a regular selling price of 5110? Do we care about this? Yes, no, anybody?
No, we not.
No, we do not care about this 5110. Why? Because that's our regular price. That's our regular price.
Yeah. Oh. Happy birthday! Happy birthday!
Oh, I feel like fresh laundry.
Okay, happy birthday, and mute the microphone, please.
Yeah.
Let me see.
It does check.
Okay, let me see if I can.
Oh yeah, just a tiny bit.
Not like this blueberry.
The milk professor.
You know. So where are you guys gonna walk?
She's the guy.
Hello.
Professor, you
Hello?
can mute students yourself, I think, from your end.
The students are.
Well, I'm looking how to do this, but I can't find it. Okay, are we here still?
Yes, we are.
Yes.
Okay, very good. So these 5110 are not relevant to us. Why? Because that's a regular price. That's full price. They're not going to pay us a regular price, and this price covers all of these costs, which are also not relevant to our special order, right? So for our special order, what is relevant? Well, how much will it cost us to make this special order? Well, it will cost us materials, it will cost us labor, it will cost us variable manufacturing overhead. Now, let's see about the rest. An order has been received 2,000 units at a special discounted price. The order would not change the total amount of company's fixed cost, so not relevant. The variable selling and admin cost would be $10.10 less per unit than on this. So we would still have this, but 10 cents less. So it will be 1.8. 1.8. And is this relevant fixed? No, right? So we will add this and this and this and this, and we will get what? 24, 26, 27, 28 to what? 29? Is this correct?
Yes.
We will get $29 by adding this and this and this and this, right? So you got to $29. So that's you did something already, and you have an answer here of 29. Is this a correct answer? Not yet, not yet. Why? Because we still have this piece of information. But again, start with the basic stuff, so you got somewhere. You got to 29. But you know that you still have to include some additional piece of information. Now, what's going on with this additional? Suppose there is not enough idle capacity. So we are producing, let's say, at full capacity here. the question might have said also, we are producing at a whatever, full capacity or something like that. That would mean the same thing. So there's not enough idle capacity to produce all of these units. But you see, in this case, actually, we have enough except only for 200 units. So we can produce 1,800 out of these 2,000 without any problems. So basically, we have 1,800 units capacity, but 200 we are missing. So we will need to cut into our regular production for 200 units, right? So what do we do now with this? What do we do with these 200 units? Anybody?
Can we buy it? Supplier?
Say it again.
I'm sorry, I don't know if I'm trying, but can we buy it to another supplier, those 200 units? Because
well, in real life, maybe, or maybe we could just tell a customer, you know what, just give me an extra week and I'll deliver it. I have some special order or something. But for our question here, no, we don't have any of that information. So how do we use these 200 units to,
like a loss?
What's the meaning? Okay, very good. That's a kind of a loss. Exactly. Very good. Now, how much a loss?
It'll be a $9,160 loss, right? Because you're using all the regular variable and fixed costs, and then you subtract it from and then you times it by 200.
It's not gonna be 10,220 because it's the regular order. It's not from.
No, but think about this. Okay, the other person was kind of close, but not
Would
exactly
you
there.
multiply 200 by the selling price per unit for the loss?
Okay, this is getting somewhere. So 200 times 5110. So that's a loss, you're saying?
Yeah, that's what I say, Professor. That is 10,220.
Yes, but is this a loss, really? Everything?
You would have to the cost to produce that. So it would be the revenue that you would be losing. So the 200 times the 5110 minus the cost that it costs to produce those 200 units.
Excellent, excellent. Which in a short version is what?
Contribution
margin. Very good, contribution margin. Fixed costs are not relevant, remember, because they are, they're given here per unit. But we know that that's not a trick, but we've seen this in the lectures and everywhere. We can be given in any way, this is at our current level of production, 40,000. So, but they are fixed costs. They are fixed costs. They're not relevant they're not relevant if they're not going to change in total anyway. So we don't need to worry about fixed costs. The bottom line is contribution margin, and contribution margin is the difference between price and variable costs. So we would simply take these variable costs here, 18 and 60, 6.8 and 2.4 and 1.9, which would be what? If this was 29 with 180, then it would be 29.10, right? 29.10. So our contribution margin would be what? $22, correct?
Yes.
Yeah.
$22, 200 units, because that's what we would lose for these 200 units. Yes, somebody else said we would buy it from somebody else. Well, but then we would have to pay for them, right? Or in real life, we would probably tell a customer, well, just, you know what, we have some delay, so wait a week or so, whatever. So we would not lose really anything. But in a case like this here, it's clearly we are working within a time frame, and this is the capacity, and we have to cut into 200 units, which we will not be able, let's say, to deliver, etc. So we would have to sacrifice, as another student said, we would have a loss for these 200 units, these 200 units here. How much loss? Well, contribution margin loss of $22. So that's 22 times 200 is what?
4,400.
$4,400. $4,400 loss. $4,400 loss. But your question is in units, right? What would be the minimum price? So you calculated here 29 already. You know it's somewhere around 29. It's probably not 51 or 47. But again, I don't want to jump like earlier and say, because the number might have been very different here with these 200. It could have been 2,000 units. So might have been 51 or whatever. But anyway, 200 units, not a lot. So $4,400 now. So what do we do is, well, we have to translate this into the units that we are buying, which is 2,000 units. 2,000 units. And 4,400 divided by 2,000 units is what? $2.20. $2.20. When we add this to these 29, we will get 31.20. 31.20. How do you do this? Again, easier, so you don't have to do this conversion at the end. Well, if you end up with this 4,400 here that you have to add, you can simply say here $29 times what? Times 2,000 units. That would give you some total, right? And then you add this total plus 4,400, and then so that would give you some grand total, which you would divide then back into 2,000. So you're just kind of going back and forth, but it doesn't matter because maybe it's working better for you because you're working all with totals. So now you divide this grand total by these 2,000 units, you would get 31.20. But kind of the main message here is because there's a lot of information here, but to get to the basic number, let's say of 29, is fairly straightforward, fairly easy. You should know this, otherwise you just don't know the topic, then it's in trouble. But do the first step first and say, okay, you get to 29. Now, what do I do with these 200 units? Well, you have to realize, like the student said, this is a loss to you. So you will have to include these 200 units loss into your price to cover for this loss. You don't want to lose this contribution margin. So that contribution margin will be something. It will be whatever you calculate here, this variable cost and original price, 5110. Now you got back to 5110, but just because of this, right? Originally you did not care about 5110, but because you're losing some contribution margin here, so you calculate it. So you get 2.2 in contribution margin, so you get to 31.2, right? 31.2. Any questions? So chapter 11 is probably the most challenging chapter. Chapter 8, sometimes the wording, as we could see today, sometimes the wording is challenging too. Flexible budget, fairly straightforward. You know how to approach this. What else do we have there? We didn't have a lot of segment questions here from chapter 7. What else do we have? And return on investment and things, performance measurement. Again, you will have your your formulas with you, and so there's nothing to worry about that part, I guess. Any questions? Okay, so this is the last one in this set. So this is a good set of questions. Let me. No questions?
I think so.